What do I need to put for a down payment? Okay, so the down payment is really determined by the type of loan that you are taking. At least the minimum down payment is determined by the loan you're taking. So that will be a discussion that you have with your lender to talk about the types of financing that you qualify for. If you're over 20% down, you're going with a conventional loan. And then if you're going with another program, there are many programs out there. There are zero down programs like the VA loan. If you are a veteran, you can work with any lender to get set up for a VA loan. All of our area here in Whitman County and Latah County qualify for the USDA home loan program. And that's also a zero down program. Now, what I'll say with that is it has a very specific debt to income ratio. So not a whole lot of buyers qualify for it because you kind of have to have not too much debt, not too much income. That's something to at least bring up to a mortgage broker, your lender, and ask if you happen to qualify for that. That's another zero down program. Then they offer programs. There's a conventional program out there, a down payment assistance program that is a 3% down program. There's a 3.5% FHA program that's popular. There are 5% down programs as well. So really, it's a discussion with your lender to determine what programs you qualify for, and then they can counsel you on the pros and cons of those programs. Now, if you're under 20%, for most programs, VA is excluded, but most programs are going to require what's called PMI. And what PMI is it's private mortgage insurance. Essentially, when you're putting less than 20% down, the lender wants some assurance in the form of insurance that if you stop making your payment, they will have a way to recoup their costs a little bit quicker than the foreclosure processes and things like that. And so they have private mortgage insurance that kind of insures them. And so that's an additional, usually a couple $100 a month that gets added into your mortgage payment for the first couple of years to ensure that process. Now, when the market is going up, if you reach 20% equity, even if you didn't put 20% down, but your house value has risen very quickly, you can sometimes get that private mortgage insurance waived. Also, if you were to make bigger payments on the principal for your loan, you can work to get that waived. But that is probably the biggest disadvantage of putting less than 20% down on a home, is that you will have this private mortgage insurance payment for a couple of years. And that's not going to go towards principal or anything. That's just an insurance policy that's part of the first couple of years of your loan. So you might have heard this 20% down payment number being thrown around. Maybe your parents, maybe somebody told you that you want to put 20% down on a home. And part of that is because of the PMI payment that we talked about. But another part of that is because if I had an offer in front of me as a seller, a conventional 20% down payment offer versus someone who has a 3.5% down FHA loan offer for the same amount, I'm most likely going to select the offer with the 20% down, because that tells me that the people are more financially secure. They're able to put a larger down payment down. The conventional loan program is a little bit smoother, a little bit more straightforward. Less things can go wrong with that program just because it's conventional, it's traditional, it's typical. Whereas the FHA program, it has more government involvement. But what I will say is what we've seen in recent years, and I think we'll continue to see, is that if you have a really good local lender and you're using one of these lower down payment programs, you still have a really good chance of getting your offer accepted, even versus somebody who is a 20% down. I think sellers value the price and the terms of the offer more than they value a big down payment.